All right, you guys. So we're gonna get started. Um, Sam, do you want to introduce yourself first, and I'll go second?
Sure. Absolutely. Welcome, everybody. Thanks so much for coming. I'm Samantha Shue. I work with Movement Mortgage. I have to say my NMLS number, so it's 1202073. And that means I'm a loan officer. I'm a licensed loan officer here in California. I've been in the industry since 2001, so a long time. Took a break in there, but came back to it just about 6 years ago. I love working with Movement Mortgage, and I also love my kids and Orange Theory when they open back up. And my vision for the world is positivity and gratitude. I always see the silver lining in everything. So just the way I was born, always part of me. Shannon, you go ahead.
Oh, yes, I would agree, Sam. You're very positive. So my name is Shannon Shue. I'm a real estate agent with Keller Williams. I both invest in real estate part-time, and then full-time I work as a real estate agent. I run a small team here. My office is in Marina Del Rey, and I sell mostly in the Mar Vista area, the Mid-City, Leimert Park, and Jefferson Park area in terms of where I focus on listings. I personally own 9 units. I'm about to add a 10th unit because I'm creating an ADU in the back of one of my properties. I love Vietnamese spring rolls, and my vision for the world is to connect with people through vulnerability. So just a little bit about us. And what we get to talk about today is going to be really exciting. This actually presentation is one that a lot of people, like, I want bigger pockets, and a lot of people think about, like, I want to know where I can invest in LA. So I'm going to use indicators that I look at when I want to invest in a property that help me understand what is the best value. So, okay. Sam, want to go through the agenda?
Absolutely. So today we're going to be talking about the latest in housing news. Really hyper local to LA. What are some real estate opportunities here in LA that Shannon will be talking about mostly? And then I'll talk about where would you start if you haven't purchased property before and you're looking to buy? Where would you start with the lender? What are the next steps? So this will be really interactive. So I encourage you guys to ask any questions that you have. We're first going to start with our next slide. If Shannon wants to push that forward, to have everybody introduce themselves. So why don't we go ahead and get started? Christina, do you want to go first?
Oh, so we're just doing a little introduction.
Yeah.
So hi, my name is Christina Chan. I am in Los Angeles. I have a marketing agency for the architecture clientele, mid-sized firms. Basically, I do personalized, human-centered marketing strategies, and I implement storytelling-based video and content. I am here to learn more about, I'm curious about investment properties. And then also, just as a sidebar, Shannon, I was hoping I might talk to you a little later about another question. So I'm just kind of like looking into the future and seeing what I can learn about investing.
Absolutely. I'm looking forward to it, Christina. And this might be able to good launch pad for some additional questions than what you had in mind too. So,
okay, sure.
Yeah. Michael, would you mind introducing yourself? Oh no, we can't hear you. You want to use the chat for a minute just to let us know?
We could go to Alan maybe while Michael.
Go to Alan, Michael, while you get your sound going.
Yeah, hi, can you hear me?
I can hear you, Alan.
Okay, I apologize for not being on screen. I've got some other things going on, but let you know, and I'm a part of the KW family out of OC Realty. I am the 1031 guy at KW.com. So people contact me from virtually all over the country with 1031 situations. My specialty has always been to increase income by parking the debt. Not going to get into the heavy of it, but I'd like to listen to what you have to say in the background.
Awesome, Alan. Well, I love your focus on 1031, and hopefully maybe you and I can talk after that. I'm definitely building it the slow way, and then we'll 1031 into more and ladder up from there.
Great. Thank you.
Yeah. Michael, do you think the sound is working now? You can test it with us. Oh, the sound doesn't work. Okay, Michael, no worries. Feel free to type your introduction if you'd like, just a little bit, and no worries, we totally get it. And we'll like keep rolling, and you can always continue to use the chat so we can see what you're up to. All right.
Wait, he said that he met you in 2017.
Yes.
Awesome. Okay, cool.
I met you in 2017. Michael, where did I meet you? Just now I got curious. Awesome. Oh, at a rehab. All right. I wonder if it was mine. I don't remember. Okay, so what's happening in real estate? Some of the things that I'm seeing as a challenge right now is we have incredibly low inventory across the board. It doesn't matter what price point you're at. The only price point where I think it's starting to really open up to a buyer's market is in the high multi-million-dollar range. They're talking like 5 million and above. It's starting to look more like a buyer's market. Between 2 and 5 million, it's a mixed bag. So you have some stuff that's selling quickly and other stuff is just sitting. So that tells you it's probably a little bit more of a balanced market in the $2 to $5 million range in Los Angeles. And then below 2 million, it's pretty much a seller's market. Stuff is selling quickly. So the inventory still continues to be low in the under 2 million. If you think about how many homes in Los Angeles are under 2 million, most of the homes in Los Angeles and properties in Los Angeles are under 2 million. Unemployment continues to rise, and that's, I think, mostly a challenge because banks, and I'll let Sam talk about this more than I will talk about it, but it means that banks, I think, are still very gun shy, very careful, and being very picky about who they lend to. I won't get into details, but I think that all of that affects one another, which also affects the economy. Despite the stock market recovering completely, I still think that that's a challenge. I think that's a challenge in itself. How did the stock market recover under the circumstances we're under right now? So it makes me wonder. Opportunities. Sam, this is some stuff. This is actually your stat. I want you to talk about that.
Yes. So purchases are up 9% year over year, which is crazy to think because most people who don't have their finger on the pulse like Shannon and me all the time think like, oh, the housing market's probably just dropping out because of, I mean, you're hearing about the unemployment likely. So you think, okay, yeah, that probably means that there's so many houses out there that I could buy under market. The sellers are probably dying to sell their houses, and that's really not the case. I mean, twice last week I heard buyers tell me that they won or lost out on offers because there were 20 plus offers on the property that they were making an offer on. So they're still going way over list price. I mean, like Shannon mentioned, there are a lot of properties out there that are sitting, and they're sitting because they're priced too high. But if they're priced well, they're going fast, especially if they're all redone and look nice and pretty to a new buyer. But what I am seeing out there is that the sellers who need to sell, they're still, people are still having life changes, right? They are having babies, they need to have a bigger house, or they're getting older and want to downsize. So there's lots of life changes that still create sellers, right? So even though the inventory is really low, there are sellers who really want to sell. And if, let's say you've seen a house that's been sitting on the market a really long time, like over 3 months or 6 months, or I've seen some that are like over a year sitting, that may mean that there's an opportunity to ask for a seller contribution. And I've definitely seen a lot of sellers lately offer to pay the buyer's closing costs. So that means it's shifting sometimes, and it's really kind of like a buyer's and a seller's market right now. For every property is almost a little bit different, but for some properties I've seen buyers get their closing costs paid by the seller. So that's great because that's like a 3% of the purchase price. So if you were buying a place about $600,000, that's $18,000 roughly that you're saving, that the seller is paying for you on your behalf. So definitely look out for those options out there. And Shannon and I talk about this all the time right now with people being at home a lot more and not being able to go out as much. They're having more time to really hone in on what their goals are and having some more time to think about buying and really getting it, you know, into the next 3 to 6 months of your your goals. So I think that's a great opportunity to really be able to have the time to spend to buy a house.
Yeah, and what I'm noticing on the seller contribution side is I'm not seeing, I mean, at least my escrows, it doesn't mean that I see every escrow in the whole city, which I think would be fun if I could. I do notice that sellers are contributing more in the negotiation for requests for repairs. They want to keep the deal together. I think before last year at this very same time, sellers were like, well, if you just kind of take it as it is, like that's all you're getting from me. Like I'm not going to negotiate much. But now they're more willing to negotiate for repairs to keep the deal moving forward. And then because there's an increased interest, at least in my perspective, in looking at investment sides, like a lot of people are like, I want to go invest. I want to go invest, right? And I've had the same people in the past say that, but now I have more people saying like, I want to invest, I want to invest. Find me a foreclosure. I've had probably twice a week, I have a conversation with someone that says, find me a foreclosure. And right now, just to temper that expectation, there aren't a lot of foreclosures right now. And a lot of the people that if they are behind and they took forbearance, the bank is going to work with them. They're not like, the bank's not going to shut them down. The bank wants to keep their asset in the highest value possible, and working through a loan modification is more valuable to the bank than letting them get foreclosed on. So I'm telling all my clients, I was like, foreclosures are still fairly low. Short sales are still fairly low.
And there's a lot of equity out there too. So,
Exactly.
Rewind 10 years when this happened with the marketing, with the crash, right? When the mortgage imploded, right? The mortgage market. That recession was really caused by the housing industry, right? And at the time, lenders were able to give loans up to 100% financing, many times as a stated loan. So we call them a CISA, stated income, stated asset, or a NINA, no income, no asset. People could just fog a mirror and get a loan. And many times they were even getting into these loans where they owed more than what the property was worth. And so they were upside down. And that at that time, back in 2010, there was very little equity out there because people were given these loans because the lending industry really wasn't regulated. Now, 10 years later, we have under a lot of regulation, and you're not able to just state your income and your assets and get a loan. That's not available anymore. Bank statement loans aren't available anymore. So you really have to be fully qualified to get these loans, and you have to have some down payment and some skin in the game. So we're in a much better position in the housing market than we were 10 years ago, way better. And so like Shannon said, absolutely, the banks are going to want those owners to keep their property and keep that equity.
Yeah. So, and I also just want to kind of speak to national news, like nationally, we will get averaged against all of Ohio. Well, and I use Ohio as an example, but it could be Missouri, right? Our real estate here in Los Angeles, we are an equity game. You gain equity over time. Missouri, you don't get a lot of equity. You get cash flow in terms of day one when you purchase an investment property. The reason as the market changes, we have so much equity. Everyone has so much equity. Even if they fall behind, if they sell it, they're going to net something from that sale. So, imagining national news where like you see all these distressed homes and these distressed sellers, that won't impact this Southern California area as hard as it will impact a smaller, less expensive, very blue collar, middle class area where we have, our blue collar people can just eke into a home, right? But we don't have as much of that. We have very middle to high income earners that can afford these higher prices. So again, you have to think like it's not going to hit us as hard. We're also deep pocket city. You know how many investors I know will just scoop something up cash? They'll buy 3 in a week. As a starter investor, you have to be very realistic about how you can start in the market. Okay, so this is my favorite thing that I look at. Like I analyze this stuff up and down and left and right. I'm looking at Los Angeles. These are the neighborhoods I focus on when it comes to listings. And this is specifically, these red boxes are 5 neighborhoods that I look very closely at. And I don't actually buy in 90066, but I do sell a good number of homes in that area. So the reason I put it there is for comparison. That's considered the west side because you are west of the 405 freeway, and then you have the ocean right there, right? And then when you get on the other side of the 405, you're east of the 405, you're looking at some of the great opportunities here. And the reason they're great opportunities on the other side of the 405 is because you still have access to the west side, and you have the Expo line that runs along up here on Expo Boulevard that takes you all the way to Santa Monica, and then the other way it takes you all the way to downtown. So Los Angeles public transportation is one of my favorite ways to look at the city because it helps you kind of see what are the opportunities. Public transportation is absolutely going to be more and more important year after year. We just can't accommodate any more cars. Unless you like being in traffic, then, I mean, we're accommodating your car by you just going slower. What I look for in a neighborhood that really has potential is where the big brand commercial real estate going. I want to know, where is the Target? Where is the Ralph's? Where is the Trader Joe's? Where is Sprouts? I don't care where Whole Foods is because Whole Foods doesn't invest in neighborhoods that I want to buy in because that's an A neighborhood. They need to know that people are making a significant amount of money to afford a Whole Foods in your neighborhood. Even Sprouts and Trader Joe's, like they're one tier down from Whole Foods when it comes to the way they look at the market and what your spend is. But I care, like, okay, if there's a new one opening up nearby, like that's a good sign. You know how much research they put into where they're going to place their commercial markets? They put a lot of research, it takes years. So the other areas I like Target. So Target to me is even kind of below a Sprouts or a TJ, and then Ralph's. I did put Ralph's on here, but I don't really look for food for lesses. Food for less is different than Ralph's, and actually, you know, it's all one big conglomerate when it comes to the big Safeway markets, and then there's the Vons level. But again, I'm just looking at where are the targets. So on this map, there is a Target here. There is a Target here, right? And there is a Target here on the other side of the 405 freeway. I just threw that on there because it's on the map. I'm more interested in these Targets over here that are on the other side of the 405 freeway. What it tells me, there's a Target here, here, and here. There's 3. What it tells me is Target is moving. They're moving east. I care if they move east because I want to buy in these eastern areas because they're more affordable. They're B-level neighborhoods, and I want a B-level neighborhood, and I want to go where the Targets go. I like seeing Starbucks, not because I like their coffee, but Starbucks also puts a lot of work and effort into where they will place, and they're corporately placed, so nothing is a franchise. And again, like I didn't put any Starbucks on here as I think it costs way less capital to put in a Starbucks than it does to put in a Target. Okay, so that gives you an idea. You can see on this side, there's just no Target and no Trader Joe's or Sprouts, but they're moving, right? So that to me tells me that they see if it moves more middle class, that the needle is moving and they will continue to move east. On the other side, you have downtown. You can't see it on the map here, but on the side you have downtown, and that's also moving. So then you can see when Target starts to move in, who follows? Trader Joe's, Sprouts, like they'll come in after. Any questions so far on this map? There's only Alan and Christina that can talk. Michael has to tell me that.
No questions, he said.
Okay. All right, so this is what I look for, and these are my favorite neighborhoods to invest in. I just bought a property in Leimert Park 90008. It was a single family house, cute little craftsman in the front. Average home price is about $790. I bought it for $642 with a loan, just a plain old fashioned conventional loan. Renovated it and then adding the ADU in the back. The ADU to the back is actually, there's a 2-car garage and a studio that was attached. I'm just going to scrape the 2-car garage and make the studio and the 2-car garage into one big ADU, a 2-bedroom, 1 bath, and I'll rent the back. So that's, you know, that's here. And then I have a 4-plex just off the map here, right by USC. Again, same thing. Like I'm very close to the Target and the Trader Joe's. that services the students in the University Plaza, right? So that I did that. I was like, I want to be by USC because USC is changing so quickly. So again, that's just kind of what I was looking for. In this area, everyone gets excited about Inglewood because they're like, oh, the Rams are coming and the Chargers are coming. I actually think Inglewood is a little overplayed. Overplayed means overspoken about, overthought about as an investment, over-invested, meaning like what you pay for is not that much. The sellers know what they have, and not that they shouldn't know what they have, but they're kind of expecting more. Because like, look, the Rams are coming. You better pay me more for potential. I'm like, I don't pay more for a development that hasn't happened, right? I want to pay what market will pay for it. So again, people get all excited because of this buzz. I don't like buzz because it makes people think everything is worth more. I'd rather go for like really bread and butter, nothing special. Oh, a Target, a Target. You know, I get excited about a Target, but I don't care if other people don't get excited about Target. I also get excited about Metro. So, okay. I did a little bit of comparison because Sam and I did this presentation in October. I think it was October last year. And I kept the old slide. I was thinking about I was going to check the slide, but I said I kept the slide. And what I did is I did 1 year from last month, because it just closed out the month, to May 2020. So May 2019 to May 2020 for each of the same 5 neighborhoods, just North Inglewood, Jefferson Park, Leimert Park, Mid-City, and Mar Vista. I took that same area. I took the whole zip code when I did it, so I didn't do just the sectioned areas. And when I did the whole zip code, you can see on the west side, an average home price in the last year was just under $1.6 million. The average home price in Mid-City was $900,000. Leimert Park was $965,000. Jefferson Park was $788,000, and Inglewood was $689,000, almost $690,000. Right, and the average square footage of each of the properties, as you can see, Mar Vista's got they're pretty large homes. They're adding square footage to add value. Mid-City, Leimert Park, and Jefferson Park, these three kind of have sort of averaged home prices. Average home sizes, and then Inglewood surprisingly has very small homes. Average lot sizes are here. Pardon me, I have a very sensitive mouse. Average lot sizes are here. Number of sold properties in that period. Okay, so there's a lot of turnover happening in Mar Vista. Almost 300 homes. This is just single family sold in a 1 year period. Whereas Inglewood, 44 sold in the same period. That's not very many homes. Right, and then Mid-City has a good clip of homes are turning over. Leimert Park slowly kind of ticking up there. Jefferson Park ticking up there. So it just gives you an idea of the turnover. So the same slide that I presented, I'm going to show you October to October of the last year. So October 2018 to October 2019, you can see the home prices are down. So that oops. Sorry. This is 1.6. This is 1.46. Prices are going up. So everyone's like, oh, find me a deal. I want to pay 10 cents on the dollar. And I'm like, how about you pay $1.10 per dollar last year? Because that's what you're getting today.
I mean, yeah, if you guys learned anything today, like make sure you tell your friends and family. Prices aren't going down. They're going up. And that's in every category, right, Shannon?
Look across the board. I mean, look.
8, 9, 7, 5, 8, 9, 7. Yeah, a little bit. Yeah.
Yeah. Every category is up. In the same, almost same, across the board. Same period last year, there were more homes selling. So I do think coronavirus slowed the sales in the last quarter. And in the same areas across the board, we're seeing higher numbers. So coronavirus took a hit on amount of inventory. It means we have less inventory than we did October to October last year. We have from May to May of last year, we have less inventory. So of course it's going to sell for more. Less inventory sells more. Kind of easy supply and demand curve.
Economy, yes. Yeah. Economics 101.
Economics 101. There you go. I won't go through all the averages here, but again, like I just want to show you that's a big deal. I really want clients and investors to know, yes, there are deals out there, but you cannot necessarily, maybe a deal is to pay what you could have paid last year at this time. A deal is to pay what the prices were in October of last year. Instead of, I want to pay, literally, I have people say, I want to find something for 50 cents on the dollar. And I'm like, if it's 50 cents on the dollar, I'll buy it. And like 3 times on Sunday. So, yeah. Okay.
Okay.
Hey,
Well,
you.
if you were able to find that cheap place, or if you're able to find a distressed property, right? Maybe you find something that nobody wants, it needs a ton of work, and you're like, this is the gem that I wanted, right? But how do I finance the remodel that I want to do to it? So I figured this might be a good time to talk about this program that we have. It's an FHA loan program called the 203K. Now, FHA is a Federal Housing Agency loan. It's a government loan. It's not just for first-time homebuyers, although many first-time homebuyers use that loan. And that's because that only requires that you put 3.5% down. Very low down payment for this program. For their renovation program, they allow you to take, and see how I have A plus B equals C, right? So with a little algebra here, A is the purchase price, B is the amount of repairs, and C is what we would call the newly renovated value. So even though in California or in LA specifically, if you bought a house for $500 and you put $100,000 of repairs into it, it probably would be worth a little more than $600, maybe $615 or something like that. But just for the loan qualification, we just use those simple numbers, A plus B equals C. And then the only down payment that you would be required is 3.5% of that new value. So if you found a place that's $500 and you wanted to put $100K into it, you would only need to come in with $21,000 out of pocket for your down payment. And then you end up with a 30-year fixed loan. It's a great rate. Those rates today are like still around 3.5%. And the $100,000 doesn't come out of your pocket. You've now financed those repairs. So actually what happens is you buy a house, let's say you find a property, it's distressed, you want to do this program. So we would talk and I would tell you, okay, this would be about how much you could get. So in value and everything. So then we would have you go through all the normal stuff. You get an appraisal, the appraiser values the property, what it's going to be like based on the contractor bid that you'll get. So he would say, okay, yeah, with all these things that you want to do, those repairs would be supported by other properties in the area for that value of $600. Then we close the loan. You put your 3.5% down, and that $100,000 sits in an escrow account that gets paid to the contractor in installments after we close. So you've taken ownership of this property. It's not that you have to wait for all of those repairs to be done to take ownership. You take ownership, we close that loan, and then the repairs happen, and that money gets paid to the contractor. And all the while, you didn't have to come up with $100,000 out of pocket to make this property the way you want it to be. This is called the FHA 203K, not K for, like K for construction in a funny way that they like to spell it. So it's an FHA loan. You need a 680 credit score. Actually, I'm sorry, I think they just changed it. Yeah, 680 credit score. It used to be 620, but they increased it to 680 because of COVID. These programs got a little stricter, but you could still do one. I have one right now. Client bought a place for $455. She wants to put about $75,000 into it, and she's only coming in with 3.5% down. So it's a really, really great program. Shannon and I used this for a client a couple of years ago who bought, I think it was like a 2-unit, and she built a 3rd unit on the property, right? And maybe converted a garage too or something like that. So that's also a way that you can do this, is buy a place that's maybe zoned for 2 to 4 units, and maybe it only has 1 unit on it already, 1 or 2, or you can add that ADU, that accessory dwelling unit, with these repair monies. So any other questions so far on this? Shannon, would you go to the next slide? So as with any home purchase, when you buy a property with financing, with a loan, you'll want to make sure that you have your down payment. So in this scenario, it was the $21,000 plus the closing costs. So closing costs also equate to about 3% of the purchase price. So you would need a total of about $39,000 to buy this place with very little down, with all those repairs included. And your payment with taxes, insurance, mortgage insurance, and everything is $36.41 a month. So that would be a really great payment, I think, to have a fully renovated place in maybe one of these areas that Shannon mentioned. I mean, I know it's probably hard to find a house for $500, but maybe on the outskirts of one of those hot up and coming areas she mentioned. That being said, Shannon and I have lots of presentations that we do, and we always talk about house hacking. So let's say this house that we're talking about is 2 bedrooms. You could then rent out one of those bedrooms and have that person help you pay your mortgage every month, right? Maybe you rent out one of the bedrooms for $1,000 a month. Now your payment's only $26.41, right? So these FHA programs are really great. Like I said, you do not have to be a first-time home buyer, but if you own other property, there are some restrictions. And it's also just good to know if you don't go with this type of program, but want to go buy a house with low down. There's still lots of programs out there with low down, like 3%, 5%, 10%. There's lots of options still out there, even though you may hear that 20% down is required. That is not the case. So just to go into a little bit more detail of this particular loan called the 203K, you can avoid paying any money out of pocket. You just do the 3.5% down on that newly rented value. You have to get a contractor in right away. So as you're making an offer on this place, you may want to have your contractor with you. It has to be licensed and bonded. It can't just be like your uncle who can do this stuff on the side. It has to be a licensed contractor. And what they do is they create their line-by-line bid of what they're going to be doing to the property for you, and then we share that with the appraiser, and the appraiser will validate that everything you're doing is supported by recently sold properties in the area. And like we mentioned, the loan closes, that renovation money goes into an escrow account and gets paid to the contractor.
And I'll just mention the contractor part because I think, just so you all know, you have, at this point in the game, contractors specialize in 203K because the level of detail that bid looks like, it actually reads like a novel. Like they tell you they're going to pay $16.17 for nails on the roof. I mean, that is the level of detail. Most contractors don't know how much they're going to spend on nails to put on your roof. So it's not just any licensed contractor. You should go to a 203K specialist contractor who knows how to write so they get paid, because other contractors are like, they haven't got paid, I'm not working. And then you're like, well, you didn't finish this, and this is part of tranche number 1. A tranche is like a payment, right? The tranches aren't being met, and you ride your contractor really hard, like, get the tranche going. He's like, no, I need my money before I go any further. So you're not working with a 203K specialist. They need to know how the tranches work, and they need to know what needs to be done. They need to submit the paperwork properly to the bank so that it looks organized and clear, and then the exact amount will get wired to them. So, okay, keep going, Sam.
All right, great. We just had a new person join us, Fedora. Nice to meet you.
Hey, Fedora, you missed the really good map. We'll see it later.
So you'll have to show Fedora later. I guess maybe at the end we can re-show it because it's so awesome. All right, so that's the 203K. You can we can always talk more about that later. Shannon, I think that might be my last slide. I'm not sure.
Yeah. Sorry.
Oh, yeah. So that's the end. But before we do that, we'll just talk about what the next steps would be if you wanted to buy today or wanted to get pre-approved. So the process would be that you have a conversation with me, and we would talk about what you do for work, how much money you have for a down payment, and what's your credit like, right? And if you don't have a down payment, there are down payment assistance programs. There's one called Cal HFA, the California Housing Financing Agency, if you wanted to Google it. And that's where you would come in with very little out of pocket. I actually just closed one yesterday. I think it was a $420,000 purchase price condo where the client only came in with $9,000 out of pocket. Done. That was it. And it's his house now. So, and he got a pretty great rate. It was 4.125, a little higher than the standard loans right now. And that's because it's a down payment assistance loan, right? There's no free lunch. But anyway, he came to me, I talked to him about what he does for work, what's your credit score, do you have a down payment, all of that good stuff. Do some back of the napkin figures to figure out what he could qualify for. Then we get the pre-approval done by looking at all of your documents, your tax returns, W-2s, pay stubs, all that stuff. And then I can issue the pre-approval letter. And right now, Shannon, if she were to show you a property, right now a lot of sellers will only show the property to a buyer if you have a pre-approval letter in place. So they're only showing it to people who are qualified to buy. And if you guys have any questions about like what you do for work, and with COVID recently, with some people being maybe off work for the last couple of months, there have been some changes to that. But if you are a salaried buyer, if you have a friend who's salaried and was off work for the last couple of months and is starting work again, you'll be able to get pre-approved so long as you have your first pay stub. So that's good news. A lot of people are worried that, you know, we'd have to wait a year or two, but nothing there. Nothing to worry about. Okay, so any questions right now? Otherwise, we're going to wrap this up.